Welcome back to part number 2 here. In this video, I want to go over some of those benefits and look more in detail, but also offer, some just warnings and try to scare you a little bit, but scare you in a, in my mind, is a responsible way of, things and components that need to be considered, need to be remembered, as you get deeper and deeper into your Forex trading journey. So, I'm not trying to play, the Debbie Downer or anything like that in regards to any of these things. But, we got to keep things, I don't want you to see one picture and then when you actually get into the reality of the situation, think, wow, that this whole picture looks a lot different. So just want to go, a lot of this is going to be for your information, FYI, but, in the grand scheme of things, I think it's going to divert you from being disappointed, because I have talked with quite a few people that, basically the moral of their story is, yeah, I got into Forex, I tried it out, but then, fill in the blank, it wasn't quite what I thought it was going to be. So that's what I'm trying to eliminate here with this video. For the most part, you've already seen this slide once back in part number 1, but nonetheless, I want to go through it again, and then, this will kind of give us our springboard into the remainder of the presentation. But yes, we're going to be looking at the 5 points of favor, those 5 almost marketing attributes that draw in a lot of people. And wow, Forex. The first one always, it's open 24 hours a day, which is crazy in and of itself. It is the most liquid market in the world. If you're not sure what liquid means, perfect. We're going to be getting to that here in a little bit. Extreme volatility, when you think about who those big players are. Another quiz question, who are the big players in the market? Hopefully you're saying, well, you got the big banks, you got the corporations, you have the world governments, and then you have, the average Joes, just retail traders. But when you have all those big players going on and some country announces one thing or another country announces another, those literally shake global economies, global markets. And when global markets are shaking, the main way you can see them shaking is, well, what's happening to their currency? And hey, Forex is a currency market. So that's where you can see those, big kind of extreme volatility, movements. Traders can use large amounts of leverage. Again, leverage, I'm not quite sure exactly what that, don't worry, perfect. I hope you don't know what it means, because we'll get to that in a little bit. And then, there is no traditional, well, you got to buy low and sell high. That certainly is a choice, but the price does not need to go up in order for you to make money, because the price can also go down. So at the surface, I fully realize this sounds like the greatest thing ever. I love the Forex market. This stuff is, 24 hours a day, volatility, leverage. The price does not have to go up. But there are, like I said, these FYIs that need to be noted, and not trying to, rain on anybody's parade or anything like that. But the whole kind of moral of the story in terms of what I'm trying to accomplish with this presentation can be summarized right up over here. For us Americans, at least, I'm sure we've all seen a hamburger commercial and can agree, wow, those hamburgers, they sure look good on those. They are just about as perfect looking as possible. And then you go to the actual place and you get one and it looks something like that. Now, don't get me wrong, those burgers are still pretty darn good, but it's not quite what the expectation is when you're seeing the commercial and seeing all the marketing and advertising. So the point here being, I want to bring down expectations to reality. Going back to, the feedback I've gotten from other traders, it's a problem of their expectations were way too high. And then when they got into the reality of the situation, they're like, oh, well, Forex isn't Forex isn't that. Well, no, Forex didn't do anything wrong. Your expectations, you just were thinking a little bit too much than what it really is. Forex is great, but it's not like it's some sort of magical wonderland where everything is perfect. Economics 101, right? There's always trade-offs, and that's what we're going to talk about more so here. Talk about those trade-offs, and then try to bring down expectations right in line with reality. Starting with this whole 24 hours of trading. Is it really 24 hours? It is indeed 24 hours, but notice I never said 24 hours, 7 days a week. That is because the market does actually close down for about, there we go. It does close down for about a day and a half. So the Forex market is open, though, 5.5 days, 12 months a year as far as opening and closing. It opens 5 p.m. Eastern on Sunday, and then it closes 4 p.m. Eastern on Friday. I guess you could say that it opens at 4 p.m. Eastern on Friday and closes at 5 p.m. Eastern on Sunday. However you want to look at that. The point being, these are the two kind of end caps to when the market is actually closed. Now, the big warning here, and this is kind of the first big, hamburger moment where we're going to try to bring expectations down in reality, is that just because the market are open for so long, which there's no doubt about that. It's crazy that there's always some market that's open that allows you to trade. It doesn't mean that there's constant action. It doesn't mean that there's always opportunities flying around. It doesn't mean that money is just raining down from the sky because there's, you can sit at your computer for 24 hours a day and just $25, $50, $75, losing $50, making $100. It doesn't quite work like that. And now I notice I didn't say that there can be not any. So it's not like there's never any action. I'm not saying that. But if you're looking for constant action, that's where you're setting yourself up for disappointment. And that's probably the main thing where people have said, Clay, I got into Forex, I tried it, but there was just never any opportunities. Are you sure there's never any opportunities, or they just didn't happen as much as you thought they were going to happen because you were under the impression that because the markets are open 24 hours a day, there's going to be opportunities all the time? If you set yourself up, your expectations up out in left field when they should be out in right field, well then Forex is not going to seem what it should. So, big distinction there. I'm not sitting here saying that there's never any opportunities in Forex. They're just not constant. They're not happening every single moment of the day. So with that being said, hopefully now you're kind of thinking, well, all right, they don't happen all the time. And, 24 hours, that is a very long time. So actually when, because I want to be smart with my time, when is the most trading action happening? If I can only pick a few moments to be at my desk during the day, or if I can only pick a few times, when are those best times? Because when is that trading action, potentially going to be occurring? So the basic rule of thumb here revolves around the overall markets and when they're open. Forex as a whole is a bunch of different markets put into one, and when those markets are open, that's how I should say it's going to influence whether or not, it's kind of more so an opportunistic time to be trading, or maybe, you can expect a little bit slowness. So let's go on to the next slide here. There are 4 main markets to consider, but with that being said, there are a lot of markets across the world other than these 4. So just because these are the main ones, yes, but it's not like there aren't any other markets out there. And this is kind of a good little segue into something I'll talk about much later in the presentation. But, at the time right now, these are the 4 major markets. But as Forex traders, we should always be at least reading the headlines. Now, I'm not saying that we need to be digging through filings and putting together vast economic theory models. I'm not saying any of that, but just reading through the headlines. And if you're going through the headlines, in some sort of routine, whether that be every morning or every night, and it's just, wow, China this and China that, and, China now has this, or maybe Russia is now becoming, this much volume. And it's just one of those markets where it's getting bigger and bigger and bigger. Now, these 4 have been the 4 for a very long time, but things can always change. So as it stands right now, yeah, these are going to be the 4 main ones to keep an eye on, but just always be in the headlines like you should be. And if you start to see something change, that'll become abundantly obvious. You'll start to see articles come up that, literally talk about the Forex market and say, hey, now, China or now Russia does a whole bunch of currency or whatnot. So it's not like you're not thinking, well, I'm not sure, are these still the 4? It'll become abundantly obvious, if some sort of transition were to take place, because, these 4 markets, what's quantifying them is the statistics that actually go with it in terms of, the volume and all that, which goes into making up those numbers. But like I said, as it stands right now, London, New York, Sydney, and Tokyo are going to be the 4 main markets. Now you're thinking, wait, says who? You're just, what makes you the World Economic Advisor? Well, when you stop and think about it, and I kind of already gave that away. Like I said, these markets are coming from statistics. But when you stop and think about it, the reason those statistics are the way they are is, well, if those are, the big markets, then that's going to be where the vast amount of traders and resources are. Resources being those banks and corporations and governments. And when you have a lot of resources and a lot of traders, when the market gets big, what's going to happen? Well, that's what's going to allow for action to happen. And that's what we want. We want action to occur. We want trading opportunities to occur. And you can't have that if there are no resources. You can't have that if there are no traders. So yeah, sure, some smaller market may be open and their currency market may be open, but if there's not that many people that really necessarily care about it because they're not a vast economy, well then, yeah, it's going to be It's just not going to be as fluid as what, these markets would be. Now let's add in another layer of context, kind of put some fuel on the fire here. And the fuel on the fire is if you can find one of these big markets when they overlap one another, now you have just that much more players involved. You have that many more resources involved, and it just provides that many more opportunities. So that's really the key thing to look at. If you're saying, Clay, when is the best time? Well, if you can, work things around to be able to trade when markets are overlapping, that truly does present a solid situation of, now I'm not saying guarantee, I'm not saying so you'll be guaranteed to have opportunities around every single corner. Not saying that, but that is when the markets are going to be, have the most volume and, be the most attractive. So looking down here at that chart right there, I'll let you pause it if you want, but you see any sort of kind of quote unquote fuel on the fire type instances where markets are overlapping. So welcome back if you decided to pause. So we'll start with kind of second place. The second place is right here, Sydney and Tokyo. You can see right here, totally are overlapping one another right there. So these would be instances where you got two major markets. They're both open at the same time, overlapping one another. Hey, that could definitely be something worth looking into and worth, exploring more. But the big granddaddy of them all is going to be right here when London and then New York open. These are, the markets for basically the biggest economies in the world. And when both of those markets are open, overlapping there for 4 hours, that can be an area where, wow, all right, that's probably going to be a location where there's quite a bit of movement going on. Again, I'm not saying that movement can't, occur in these other portions. I'm just saying that, when you want to add in that other layer of context, and when you want to dump a little fuel on the fire, those are the moments when you're going to want to aim for and be ready for, because, it just goes back to the understanding the fundamentals of, well, who makes up the market? And when you stop and think about that, well, okay, so if you have all those players from that country and then all those players from the other country and everybody's acting around at the same time, hopefully you can see, all right, yeah, that would make sense why there's so much, opportunity and why there'd be, chances at good action happening. Liquidity. So what the heck is liquidity? You now know and have an understanding that, okay, the markets are not open all the time, or they are open pretty much all the time, but there's not always constant action, and the action is kind of coming from liquidity, amounts of liquidity. But what is even liquidity in the same? I don't even know what that means. So, and my full disclaimer, and I always like to tell people this, when I was new, I thought liquidity had something to do with like a wet substance. Like I was like, okay, so I never claimed to be a genius, when I got, and I'm still not a genius, but yeah, I thought it had something to do with like just a wet substance. So liquidity in its simplest form, and I don't know if this is the dictionary definition, this is just how I envision it in my head, is the rate of speed at which an asset can be converted to cash. So the rate of speed at which an asset can be converted to cash. Keyword there being converted. So let's go through a couple quick examples. What is something out there, if you say, okay, Clay, so tell me what a very liquid asset would be. Well, it's when somebody hands you a check. That check is an asset because there's some value in it. What's the value in it? Well, it's money written to you. But can you go to the grocery store with that check and be like, here you go, I'll take those tomatoes and onions and peppers? They're going to say, no, we don't take this check. Why is that the case? Well, it's not a check to them, it's a check to you. So what do you have to do? Well, you have to convert that check into cash. But this is very liquid because the rate of speed at which you can do that is super fast. You go to your bank, you hand them the check, boom, just like that, instant cash. They give you cash in hand right away, no questions asked. And of course, we're assuming that the check on the other end doesn't bounce or anything, but it is a very liquid asset. Having a personal check made out to you, or even better yet, like a cashier's check, made out to you, very, very liquid asset because it can be very, very quickly converted into cash. Now, what about something that's not liquid? And this pertains to me given, I'm in real estate investing, but real estate itself is not liquid at all. Now, is it an asset? Yeah, absolutely. What makes it an asset? Well, real estate, they have value. There's value in a house, there's value in a land. So there is value there, but let's go through and if you've bought a house, hopefully you see where I'm going with this, but if you want to convert that asset, so if I have a house or I have a piece of land, or whatever, and I want to convert that into cash. What do I got to do? Well, I got to try to sell it. So you put it on the market, and right there, now you got to wait. Well, that doesn't sound too liquid, meaning, it sounds like it's going to take some time to convert this asset into cash. So you put it on the market, but you got to wait, and you don't do anything until you find another party, more specifically, another buyer, because you would be the seller. But until you find a buyer who agrees that it's worth that much, then you're waiting. But not only that, then you have other things to go on. You have house inspections. You have appraisals. The bank has to get involved, assuming there's a loan, because, well, they're not going to loan on something if you're way over, they're not going to overloan on it. So then you have all that paperwork that needs to get done. And while all this is going on, you have no cash. So only until you find that buyer and get paperwork completed and all that other stuff, clears, then you get cash in hand. Sometimes this can take a few weeks, few months, or it may never even happen. Because maybe you just way overpaid for the house or whatever, and you're never going to be able to convert that asset back into cash. The point here is non-liquid. It does not happen fast. And even in a great scenario, let's say you put your house on the market and it quote unquote sells within 3 minutes later. Well, a sale in real estate means all that paperwork and stuff still has got to happen. So it's not like you convert it to cash within 3 minutes. You still got to go through all that other stuff, which would still take a few days. But that's an absolutely crazy scenario. So even in crazy, it just goes to show that real estate not liquid, but a check in hand, very liquid. So that's what liquidity is: the ability, the rate of speed at which an asset can be converted into cash. Now the great news here, and I've already kind of alluded to it, but the whole liquidity thing is just not a worry at all. This conversion from an asset to cash, not a problem at all, and it's not even really close. Like, it's not even up for debate. And I've checked multiple sources because these numbers are so crazy. I'm like, is that really true? So while these numbers I'm not going to call exact because you see them vary, but even the thing is, even if they vary by like $100 billion or they vary by $500 billion, it still doesn't matter, which just shows how crazy it is. So, this down here shows the average trading volume, and trading volume and liquidity, the volume is what's allowing that conversion to take place. So volume, liquidity, basically one and the same. Liquidity is the rate at which you can convert, but then the volume is actually the conversion that's taking place. So looking down here at the volume, the second biggest is right here at 22.4 billion, which would be the New York Stock Exchange. And don't get me wrong, that's a whole lot of volume that's occurring, on average per day. Even the lowest one down here, London, $7.2 billion. That's a lot of volume in a single day. And then you get to the Forex market, 5 trillion. Like I said, I've seen this vary, give or take hundreds of billions of dollars. But, even if you cut that in half, like, all right, well, this number is still, let's say 50% wrong. Well, that still puts you down here at $2.5 trillion compared to 22.2 billion. So the Forex market is just absolutely crazy. But once again, and that's why I wanted in that first presentation to just quickly go over who's in the market. Well, when you think about who's in it, when you have freaking world governments and you have those massive corporations and you have the banks, it's okay. I guess that makes sense, but it's still, even thinking it like that helps it make sense, but it's still pretty crazy. So as far as liquidity is concerned, that's just not an issue at all. Especially if you stop here and think, I don't, but let's say I had, $200 million in my portfolio, and that's why I want to trade. I wanted to always be putting $200 million into a position. The Forex market would laugh at that. They'd be like, yeah, what's your point? There's an average daily volume of $5 trillion. Like, who cares? Like, I'm not impressed. So, and if if you have $200 million and you're watching this course, hey, thanks. That's nice of you to spend 99 of that $200 million on this. But, that was a terrible joke. Anyways, so the whole point being, assuming you're normal, and even if you're not normal, even if you have a $5 billion hedge fund, $5 billion compared to $5 trillion is just a drop in the bucket. Now that I'm going to piggyback off that whole little discussion about, $5 billion or $200 million, because that is where leverage comes into play. Now, what is leverage? Leverage is a way to take your existing money and then grow it immediately with the click of a button, literally. And this all comes from the fact of the Forex market. The brokers are willing to give you and I big leverage because I mean, there's just so much liquidity out there. And because there's so much liquidity, leverage, it almost becomes like candy. Now, we'll get to that here in a little bit in terms of, that sounds good, but there's so much volume that leverage starts to get handed out like candy. And because the brokers understand there's not going to be a threat to them, there's not a high risk that something may happen and then they're going to get burned on their end because there's not quite enough volume out there. Plenty of volume, so leverage definitely is, readily available. And like I said, leverage, basically it all works like this. You have some sort of amount of money, and then all of a sudden you click a button and that money becomes that much more money, just like that. That's what leverage is. So what do I mean by click button? What button is being pressed? I mean, do you literally click a button? How exactly is that working? Well, kind of. But when you sign up for your broker, you are literally going to click the choice to have a margin account. And I believe for the most part, though, Forex accounts are margin anyways, but all brokers can be different, so there can always be nooks and crannies. So I'm just going to assume that you may have to click to choose a margin account. So that is the click of the button. When you're going through the application, the sign-up process, you will click what kind of account type do you want, and you would click, well, I want to have a margin account. So that click all of a sudden gives you this ability to take, modest amounts of money, or really any size. This could be 5 million, and then all of a sudden you have, 500 million. But it allows you to take one size of money and then convert that into, a much bigger size of money. But what is this margin account? Well, a margin account is essentially like a little bank that's inside of your broker. So this little bank is going to lend you additional money to trade. So in our case, it's Forex, but a margin account leverage is not just specific to Forex. There is leverage in stock accounts and all of those other areas of the market. But all it is your broker. If you want to picture it, has a little miniature bank inside of it, and your broker says, yeah, we'll lend you some money to trade with. And I hope you're saying, all right, now there's lending of money going on here, okay? And we'll get to that here in a little bit. But let's first actually go over the numbers so you can see exactly what these leverages mean. As you get more and more in depth into the Forex, and specifically start to look at brokers and stuff like that. But how exactly does leverage work? Well, all brokers have different requirements in regards to their margin accounts. But with that being said, it's super easy to calculate. By no means is this like calculus or rocket science or anything like that. So if a broker, let's just say, has 10-to-1 leverage, that's what they're telling you in their their specs of what comes with us as a brokerage, and they say 10-to-1. That means that for every $1 or whatever currency you're using, you deposit, you can then trade with $10 of leverage. Or in other words, for every $1 you give them, they will give you $9, which puts it up at $10 worth of trading. So you give them $1, you all of a sudden have $10 to trade with. That's what 10-to-1 leverage means. The Forex market, separates themselves from other markets due to the large extent of leverage that is available, especially compared to the stock market. That's why I make the comment, like it really is. It's like candy being, handed out to everybody. But that all circles back to the whole liquidity. I was going to say liquidity problem, but that's not a problem. It's the liquidity benefit is what allows these brokers to understand and have it work out on their end where, yeah, they can lend out money. They can allow leverage to happen because of all that liquidity. So, it's liquidity, leverage across the board does vary, but it's really like this example here is kind of silly. I mean, that's for sure on the low end of what you would see in terms of leverage, but I would just want to do that for math. But over here, you can see just some different conversions in case maybe you're still a little unsure on the math. So if you put in $1,000 and the leverage is 2-to-1, that means you have $2,000 of purchasing power, or you can just look at purchasing power as, money you can put in the trade. Here's 10-to-1. So if you do 1,000, 1,000 times 10 equals 10,000. Here's 50-to-1. So if you put in 1,000 multiplied by 50 equals 50,000, and you get so on and so forth. You put in $1,000 and you get 100-to-1 leverage. Yes, 100-to-1 leverage does exist for Forex brokers. Now, if this was a stock market, you would never see that. And if you did see that, I would never touch that broker because I would assume there's some sort of scam, because that is way too much risk for that broker to be taking on to be offering that out there. So there is, I guess I can't say there's for sure nothing out there in the stock market, but if there is, I'd love to just interview that, the broker's owner and be like, like what are you, what kind of drugs did you do growing up? Was it meth? Was it crack? I mean, who's doing your risk calculations? Because that would make no sense. But in Forex, yeah, you could definitely see 100 to 1, 150 to 1, 200 to 1. So again, 200 to 1, and you put in $1,000, 1,000 times 200 would give you $200,000 worth of purchasing power, worth of trading power, and all you did was put in 1,000. So that's pretty crazy. I mean, that's crazy, right? That is leverage at its best. That is taking one amount of money, and then all of a sudden, with the click of a finger, all of a sudden you have a whole lot more to trade with. I hinted at this already when I made a comment about margin accounts, or kind of like little miniature banks that are lending, but maybe you notice it way before then, or heck, maybe right now you're thinking, this is awesome. I can take $1,000 or I can take $100, and then all of a sudden I have $5,000, $50,000 worth of buying power. Yes, that is true, but you better be ready, and this is where I'm going to try to scare you, and I hopefully scare you, and I don't want to scare you in the sense of, so therefore don't trade Forex. I'm not saying that. But I am definitely trying to scare you in a way that says, all right, time to get serious. I really need to respect all this because things can get pretty nasty pretty quickly. So yeah, leverage is, it's amazing. It's kind of just like head scratching, like I can't believe that goes on, but it does go on, and you need to respect it, because if it doesn't, then you can end up in a world of harm. And leverage really is like a train plowing right at you if you're doing this. So again, not trying to scare you into just totally scare you away, but scare you into respect. If you are treating the Forex markets like a casino, then yeah, it is literally like a train coming full bore right at you. And the train, is actually going to be called a margin call. And a margin call is just simply when your broker, who is constantly calculating, they're constantly watching your trade values, because remember, they're a bank, they got to protect their money. But if something spins far out of control, your Forex position, they will take action and liquidate your position. So you should know what liquidate means. That means they are going to take your asset, which is a currency, and they're going to liquidate that back into the cash of a currency that they care about. So in other words, they're just going to close your trade for you. And if it ever gets to that point, that assumes that the trade has already gone very wrong and you are taking a massive loss. And when I say massive loss, I'm not saying massive loss in the sense of, hey, I put $500 into my Forex account, now my $500 is lost. That would be the best case scenario. But the worst case, though, is it can wipe out that $500 and then leave you owning more. So if you put in $500, because of leverage, you could end up losing $1,000. So when you do the math there, well, you lost $1,000, but you only had $500 in your account, which means you still owe how much? You still owe another $500 to your broker. And that's when you get yourself into the situation where the broker's gonna be like, hey, give me my money, and you're gonna have guys like this knocking on your door because you owe your broker money. Remember, they are a little mini bank, and you don't want to get into that situation. So that's why you got to treat Forex, you got to treat all leverage situations as very, very careful. But in Forex, that much more so, because, well, with big amounts of leverage, and if you're being just hey, let's go have some fun at the Forex casino. Well, at the casino, you're only going to lose. There is no leverage. Casino, you're only going to lose what's in your pocket. In the Forex casino, you can lose what's in your pocket and then still have to owe that much more. So be very aware of that, and just get ready to, respect, take this stuff seriously. If you showed up in this thinking that you're just going to kind of do it as like a little side hobby, have some fun, throw some money around with that leverage, then don't do it. Now, if you want to not use leverage, fine, go treat it like a casino. Because the most you can lose is what's in your pocket. But if you're, I'm going to go have some fun, throw some money around. If quote unquote throwing some money around includes using leverage, don't do that. Just save yourself the headache, because you are setting yourself up to literally get crushed by that train. And I should note the guy, driving the train is this guy down here. So you don't want to get hit by his train, because it's not a pleasant experience. Go do something else with your time. Now let's talk about volatility. And this is one where I guess going through, I probably should have started out sooner, but there's always words out there where if you don't understand what they all are, it's kind of hard to explain other topics. But I want to revisit a previous bullet point. And this comes from, the 24 hours where I said, warning, just because the markets are open for so long does not mean that there's always constant action. So what do I mean by action? That's kind of the keyword there that I've been using quite a bit up until this point already. But action is just volatility. So what is volatility? At its core, volatility is what presents us as traders the opportunity to pull profits from the market. So if there is volatility, that means there is action, and action is just movement. And what do I mean by that? Well, it's just simply what distance does a price move up and down. And, that's kind of what this roller coaster is doing. I mean, if this, this roller coaster is very volatile. So, volatility is not just specific to the Forex market or the stock market or, the options market. Volatility is, heck, somebody's personality could be very volatile. 1 minute they're, oh, how are you doing? And the next minute they're throwing baseball bats across the room, and you looked at my girlfriend the wrong way, and, they could be very volatile. But in the world of the market, volatility is just simply what distance does a price move up and down. So, if this was in this roller coaster example, this is very volatile, and then it comes all the way down here, and then it's not volatile because it's just going sideways, not volatile. And then all of a sudden it gets volatile. Look at that big old distance, and then right here, not very volatile because it's just not, or really not volatile at all because it's just going sideways. And then all of a sudden volatile again, and then once again not volatile because it just levels off. So if there's the bigger the distance a price is moving up and down, the more volatility you would say it has. Again, I'll say that again. The bigger the distance the price is moving up or down, the more volatility you would say that the action is having. So keep that in mind. That's all that I mean by volatility. Volatility is action, and you can't have constant action in the market. So the market is not always volatile. There's not always massive price swings at every single minute that the market's open 24 hours a day. There are times where the price is just doing this, sideways, sideways, sideways. But instead of going up, it just sideways, 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 sideways. And then all of a sudden maybe something will happen, and then sideways, sideways, sideways. So keep that in mind. That's what volatility is, and there's not always volatility. But when volatility does happen, it can get moving pretty big. So again, going to try to scare you into respect, not scare you away, but if you go to the Forex casino and then all of a sudden some sort of volatile move happens and it goes against you, of course, if the volatile move goes in your favor, well, then you're going to be very happy. But if it goes against you, which over time, at some point in time, it will, then see you later, bye-bye to your money. And then, we go back to the whole leverage where, you may be getting hit by that train depending on if you're using leverage and how much leverage you're using. But there are strategies, and you got to be risk management rules, risk management systems. That is going to be how you take advantage of volatility, because you have to be able to not really take advantage of volatility. You need to protect yourself against it, because, and the way trading works at the, the high levels of, professional trading and all that, when you are protecting yourself against volatility, you are actually then taking advantage of it. Because, if something goes very volatile against you, then you get out, you take a loss, yes, but it's not like it blows up your account because you're being focused on risk management. But if the volatile move goes in your favor, and then, the sky's the limit, who knows how big that win can get. So volatility is something that can certainly crush you, but if you're aware of it, if you take risk management seriously, if you're, not going to treat this like the casino, then volatility is certainly something that should be embraced, because while volatility doesn't guarantee you're going to win, it does guarantee that there's opportunities, and that when you are right, because at the end of the day, you got a base a 50-50 chance. So when you are right, who knows how right you can be. But when you're wrong, due to the risk management systems, you can define how wrong you actually want to be. So don't be nervous about it, because like I said, at the end of the day, if there wasn't any volatility, there'd be no opportunity for profit. But it's all about our risk protection shield. We got to have a shield of armor out there against this stuff, because, without that, without protecting risk, without being focused on risk, volatility can definitely, get you, even if you're not using that much leverage. Maybe you're saying, all right, that leverage thing scares me, so I'm just going to use a very small amount of leverage. But risk management, that seems kind of boring. I just want to win. And then some sort of volatile move happens. It can still crush you, even if you're not using, if you're not using any leverage at all, then your account will just go to zero. But if you are using just a little bit of that leverage, then it could still end up biting you. So risk management is definitely the key thing here. And a part of risk management is position size, which circles back to leverage. So you're always going to make sure that you're not over leveraging yourself. But point here is you gotta, serious traders focus on risk, and they're very aware about how they are controlling risk. And then finally, the whole price drop thing. Well, or I should say price direction. Who cares? If the price drops, that doesn't mean that there isn't any money to be made. It doesn't automatically imply that you're losing money. If prices drop, then you could actually be making money. And the fact of the matter is, I realize I've been kind of talking up Forex here, but this is not unique. This can happen in any market. But nonetheless, hey, it happens in Forex. And it's a great thing as a trader when you're just like, who cares? I don't care what direction the price goes. As long as the price does not go sideways for the next 10 years, then that's fine by me, because whether it goes up or down, I can still make money as a trader. So that truly is the who cares attitude, is the attitude that you want in regards to price direction, right? If you're saying who cares in regards to leverage, who cares in regards to volatility, I'm not using risk management systems, well, that's a whole different who cares. But in our case, who cares in regards to price? Hey, that's great. That's a very convenient thing. So how can money be made in the direction? So we're going to do a little lingo here, but if the price goes up, you can make money, and this is the traditional one, right? Buy low, sell high. Lingo-wise, if you want to sound cool, that's called going long. So when you're going long, you are buying, and you are buying because you think the price is going to go up. If prices go down, you can still make money, and this is called going short. So going short, in a basic definition, that's how you make money when prices go down. Prices go down, you want to go short. That is called shorting. And that is the mechanism by which prices are not going in the traditional way. Prices are falling, and you can still make money. Now, if you have absolutely no idea of you now know what shorting is. Shorting what? It gives you the ability to do what when prices go down? Hope you're saying it gives you the ability to make money when prices go down. Absolutely. If you just want the very practical definition, that's fine. Now, if you want all the nitty-gritty details of how this is actually possible, then I do have a video out there that you can go and watch right there, which I'll give you the link to. But I'm telling you right now, this is just an FYI. This is not going to make, and I'm not trying to, persuade you to not watch it. But, the practical sense is shorting allows you to make money when prices go down. And that's it. So when you see on your broker something that says go short or anything like that, all that's saying is if you think the price is going to be going down, press that button, because this is the way that's going to allow you to make that money. So keep that in mind. And, with all that massive, flexibility and such within the market, all you need is just the price to move. So, flexibility in the sense of, for this slide, I was really just thinking on the prices going up or down. But now when I kind of stop and think about it and I'm talking out loud, flexibility in the sense of all that liquidity, the volatile movements, the leverage that can be used. Like I said, you don't have to use all your leverage, but the leverage in and of itself, assuming, of course, you're taking things, seriously and being responsible, that gives you a whole lot of flexibility. So, flexibility along, with the up or down price movement doesn't matter. Those other areas really do, are quite nice for the Forex market. A whole lot of flexibility and choices to make. But on the same token, there's still a lot of bad choices you can make, if you're not taking this stuff seriously. So that wraps it all up. Again, just to reiterate this slide, you can go and watch that video. You can run it. What is shorting if you want to learn exact dynamics of it. But shorting, when prices are going down, you can make money, and that's how you capitalize on prices going down, is you would want to be on the short side of things. And we'll, look into more of that too as we go through the presentation. But, as it stands right now, that's the whole, going short, shorting, what all that means. So we got all the benefits wrapped up. Hopefully now you see that, yeah, these things are benefits. But that was my goal. I wanted to insert a but. Yeah, that's great, but, fill in the blank. This needs to be considered. But, all right, I need to consider these times to trade. But, all right, I better not treat things like casino. But, yeah, I better start to learn more about risk management and stuff, because, that's what's going to keep expectations in line with reality. You can't show up thinking that this is going to be some, just ATM machine that spits out money at you because it's open 24 hours a day and has a lot of liquidity and you can use a lot of leverage. I totally understand that's how some people kind of pitch it, but and those parts are true. but you got to look at the other side of the token and just have a full understanding of what's going on. So let's keep on learning more. I'll see you back for part 3.